You're on
Now,
now.
what is up, everybody? Welcome back to the Russell Journal. My name is Russell, and this is my journal entry for what is this? January 2nd. It's Monday, January 2nd, 2023. Everybody, welcome back to the Russell Journal. Sorry, that's not supposed to be it. I hope you all had a good weekend. Happy New Year to everybody. I hope this year is kind of everybody's year. I hope we really make it and we do well. I have had just like an epiphany of revelations of things that have happened to me over the last couple of 3-4 days that, really changing a lot of everything. And really where I'm going with it is the truth is I don't know anything. I have nothing that I really know about myself and my performance. And this has sort of shifted my goals. Originally going into this year, my thought process was to have account growth goals, but none of that is possible. And part of the reason none of that is possible is because what I'm lacking is true data and true performance data. Okay. So let's go over a few things. I'm going to take these off. It's a little hard to see the screen with those glasses on, this computer screen I'm using. All right. So up here, you can see that this is the starting balance for the year. It's a very small account. It's not very big. And as of, if you were here last week for any of the stuff I talked about, my goal was ultimately to try and grow this account by 3% every day. So, there's a few of you within the comment section in the live chat that seem to think that this was a bit of an asinine goal. Now, my only defense for this goal at the point was essentially that I had been successful focusing on 3% a day before, that in December I was being successful focusing on 3% a day. And so I began to spreadsheet out the goal of 3% a day. And what my spreadsheet came out with is over the course of the next 252 trading days, if I do 3% a day, if I'm capable of growing by 3% a day, this would turn into the end of the year, it would be go from here to about $455,000. I'm going to say that one more time so that you make sure you heard it. If I focus on growing this 3% a day, by the end of the trading year, that balance will equal $455,000. The reason I am saying this twice, that is unrealistic. As a matter of fact, that's downright impossible. And when I saw those numbers, I thought, I must be mad. I must be absolutely insane to think that this is possible. Okay. And we will go over why this is impossible, but we'll also go over it to see some of the other stuff. So when I realized that, you're looking at a 20,000% increase in your trading account within a 12-month period. If that were doable, if I could do that, if that's all it took, right, I would be worth billions. There would be people coming here to pay me billions of dollars to manage their money and make that same sort of thing happen. That is just completely unrealistic. Okay. If there is anybody out there who has done this, or you know of them, please let me know. Please please put that in the comment section if you know anybody who's done that. Now, I do know guys who have a $100,000 account. They do shoot for a 1 to 3% growth per week. And that's trading. That's what they do. But the idea that you're just going to infinitely continue to scale this at a rate of 3%, right? You're basically saying, well, 3% is my top, right? That's my goal. But that means that the dollar figure of that percentage is an infinite growth dollar figure. Not very viable not realistic, nothing, right? And we'll show you why that is, and it will make sense with some of the other stuff that we have to talk about. So upon realizing that this was a insane idea that I was going to try and do, again, and I have another thought around this, but we'll save that for the end and see if I remember to get back to it. Okay. So really what I began to say is, well, what's going on here, right? What's going on with my trading? Where are things at? Okay. And in all honesty, I began to take my trades from December, and I put them into a spreadsheet. And I thought, okay, well, how many trades did I trade? Okay, so I actually went back, and it was basically a 13-day period from essentially right around the first trading day I took was the 13th of December, all the way to the 30th, right, 31st. And within that period of time of those trading days, there was 13 trading days there, and I placed 31 trades. Okay, now of those 31 trades, 18 of them were winners and 13 of them were losers. Okay. Now, as far as performance goes, this is a good sign. You want to see that you're getting more winning trades than losing trades. The problem that I had throughout that period, okay, was that of the winning trades and the losing trades, I was making about $10 for every winning trade. And for every losing trade, I was losing an average of about $15. Okay. So my risk to reward ratio was 2 reward for every 3 risk. So now I can already see that my system is really wrong because I'm not accounting for what the risk should be to reward setup. Okay. So again, looking at this just in this short window. Now, the few things that we should know, and I should note, is that everybody who I've talked to who has begun this process, the spreadsheet, the data collection, the performance-based analysis, they're looking at 90 days worth of trading. They're looking at one setup with a minimum of 100 trades underneath that setup before they're evaluating what the things are. Okay. But so from what I can see here, though, it's not so much to have exact specific data for me as it is for me to get a window into my beliefs, my limiting beliefs around trading, the beliefs that are way out of range and things of that nature. So we're going to go into this. I've got some stuff lined up here as far as like the trade stuff goes. I want to check with the live stream, see if you guys are see anything. All right, so nobody's in the live stream. So again, I guess this is going to be an episode mostly for me, and that's fine. I'll be able to refer to it. Okay, so there's some stuff about this that we need to think about in terms of risk reward. We need to think about in terms of how we're going to set up the setup for the data collection. Okay, so again, we can start with a balance up here, $278. That's fine. That's fantastic. Okay. Now, what we're going to do is we're going to try and keep most of our position size from being we want them to be about 20% of that balance. Okay. So this is going to give us between $50 and $60 as far as almost $70, to be honest with you, as far as, well, that'd be 25%. So we're probably going to be right around $60. We're going to see. Okay. So I've identified here upon our options table an option, and we're going to see how we're going to look at and think about how the risk and reward sets up here. Okay, so here you can see we've got the 390 call expiring tomorrow. Okay, and that's now again, this is all going to be different on the day. Tomorrow when we wake up, this will be different. The strike will be a lot closer due to the theta burn from the weekend and stuff like that. So don't think this is 100% accurate. This is just the best I have right now, but the principle still align and the math still aligns. It's just not perfect for the trade. Okay. So going in, we're looking at this call here. You're looking at the 52. It's going to be about $52 worth of premium in order to do this. Okay. What you have to realize here is then what we're looking at as far as our risk profile goes, and this only deals with the intrinsic value of the contract, right? This is not accounting for what people might bid, how they might chase these contracts. They might be willing to pay more if the volatility moves in their favor and things of that nature. This is really just an analysis of where things can go really horribly wrong. Okay, so and thinking about our risk reward profile. So we can do this with delta. Okay, so if you don't know what delta is the number assigned to your contract that is for every move, every dollar move in your favor. This is how much you can expect your contract intrinsically to increase by. Okay, so right now, if we move $1 in our favor, if the move is $1 in our favor, this 21, you can expect your contract to increase by $21 in value. Okay, now if you move $1 away though from your current from this, right? We're looking for it to go up towards 390. You are going to lose $21 for $1 move against you. So immediately when we go to identify the trade, right, we notice that our possible, like we have a potential $1 move of 20 that will make us $21. Okay. We also have a move that can cost us $21. So for this to set up into some type of classic risk reward scenario, where we need to see this in order to take this trade, it's fine to risk the $21, but what you have to do in order to take this trade is mean there has to be a potential $2 move in your favor. Okay, just from these links, right? And that will give you a 2-to-1 risk reward. Now, the cool thing is I did leave the gamma on here, so there is some stuff within this trade that lets us kind of analyze this. You don't really need a full $2 move in order to catch the 2-for-1. Or if you do catch a $2 move in your favor, you can have the 21 plus the gamma plus 21. So you get your delta and you add that 6 to it right there. And so essentially, if you did catch a $2 move with this, you would make $48. And for that $48, you would minimally be risking around $21, assuming that it's a perfect world where everything fits in perfectly. You know, it's whole dollar to whole dollar. And again, a lot of this is just to give you an example of theoretical. Now, here's where this gets even more interesting, though, because my account balance is $278, almost $280. So where you are with this here, that becomes really majorly interesting, is that now you look at that percentage of your risk versus your account. So $21, in order to get a 2-to-1 risk reward, I have to risk 10% of my account. See there where that becomes, you're like, oh, is that a viable trade? Am I really willing to risk 10% of my account value to make that much money? Now, so there, that this is where I'm running into some confusion as to really, how do I assess this risk? So what I want to see, what I need to find, I need more data that supports entries of this, of similar position, right? I want to find entries with a similar position that have a higher probability of going in my favor. Okay. So the risk reward is set up. We understand the risk reward. We understand the stuff like that, right? What we need then is a setup with the probability that is going to show this as a correct probability. Okay. Looking to see, nope, nobody here. Okay. So going into this year, I had this sort of plan. I was going to grow my account by this. I was going to do this. I was going to do this performance every day. And now my New Year's resolution is to collect data. All I want is to collect this data. This is my New Year's resolution, is to prove whether the setup works or doesn't work, where it works best, where it doesn't work, right? One of the things I think that if we do a review of last year, the number one thing I learned was when not to trade. Learn when not to trade. Learn when this is, just because your indicator is making the move does not make this a viable trade setup. Okay. So learning this is where I have to focus. This is where I have to dial in, where I have to really nail this. Okay. If I can do that, I think I can be successful. I think I can become a professional trader. But over the course of the next 90 days, the next 3 months, right? This channel is going to be really focused not on trading goals, not on making money. It is going to be collecting that data. I think that is, as a fledgling trader, this should be my first and foremost goal. Get that data, okay? Maybe it will be with the money, real money. Maybe it will be with paper money. I would like to try and collect the data with this money that I have. I would love to be able to do that because I'm overconfident in myself and think that I can do that. And the other thing about it is, if you've paper traded with Webull, it sucks. Paper trading with Webull is really it has a lot of lacking information in it, right? And there's a lot of temptation to do things with paper trading that you would not do with real money. There's a temptation to have too big of an account. There's a temptation to, take a big win, to buy way more contracts, to do things that are not realistic. So I'm going to attempt to collect this data with real money. It is not a lot of money, but I would like to try and do it this way. I will hear your objections in the live stream, in the live chat and the comment section. Okay. Now, that is as far as my goals as a trader and trading behavior. I'm going to run in and we will look at the chart to get some type of context as to how we think that we are going to behave into this year. Okay. Again, there's some stuff that I want to go over just because it's fun. And maybe we can talk about it. Maybe there isn't anything to talk about. Hard to say. Okay. So we're going to set up this chart really quick. Okay. So you can see on the yearly chart, we essentially basically took back in 2020. Okay. Let me go over here so I can get my fingers right. Okay, in 2022, we basically undid mostly everything we did in 2021. Okay, this is the first thing. Second thing, I'm going to get rid of that off the screen. Okay, so we essentially took out pretty much everything we did last year. Okay, this doesn't really tell us anything other than that's what happened. Okay, I don't think you can look at this candle and go, oh, it did that on the yearly. That means it's going to do X, Y, or Z. And to be honest with you, especially from talking to some of the traders, some of that thought process around there tends to be a little bit of there's a lot of fallacies in that type of thinking. And so I want to expunge that, but I do want you to see that. And I do also want some of this does need to play into some of our thinking, because on one end of this, there is a group of people out there who are going to say, oh, we got to stay as far away from stocks as possible. So you can limit your buyers this way. The other thing that you might get with this, though, is another group of individuals coming in and saying, look how cheap they are. Look at how cheap these stocks are. They're so cheap. We are getting such a good deal. So there are places where you're going to get buyers. So I think the idea that the buy the dip crowd, I've seen this on Twitter, some people banging for the buy the dip crowd to be dead or to be gone, see that trend end. I don't think so. I think, to be honest with you, you get it more this year than you did last year. Again, this is just market talk. This is nothing around how you should trade or any trade behavior. So I want you guys to understand that like most of the stuff I'm saying is not about just entirely trading. It's just kind of ongoings around the market and thinking around the market. And you're going to experience people talking like this, through Twitter or in the Weeble comment section or, or in any forums. You're going to hear those conversations. So I don't think that you should ignore them, because those are participants, and we're all market participants, right? And I think that you should be aware, because being a trader and stuff isn't just it's not just a behavior. There's a whole culture here that does matter, and I'll tell you the thing about it, and I think the reason why I like the idea of the culture within this so much more is because the culture outside of trading gets everything wrong about the markets, right? Everything wrong about the markets, right? Everything from the whole principles of Warren Buffett, right? His stuff is designed to keep you from being interested, to make you think it's too dangerous. And again, my theory of capitalism is the end game is that everybody will have to be invested or trading some type of financial product in order to generate money, because with automation and AI and machine learning and things of that nature, we are going to automate labor completely out. Okay. So it will have to be a game of trade and exchange of some type of equity as far as generating wealth goes. And if you don't, I don't think that you'll be able to participate. So so some of this I think is important, and I hope that anybody watching who doesn't know anything about stocks gets interested in this. And on top of that, I have a lot of conversations about stocks and trading with people who own 401ks, and they're just dollar cost averaging into their 401k, and they think we're the same, and we are not. Right. And there are tons of people out there who think they understand markets, and they're having a conversation about just dollar cost averaging into things and building, and they think we're having the same conversation when I'm talking about trading, and we're not. We're not. The behaviors are different. The functions are different. The ideology, the mentality, the disciplines, all completely different. So excuse me. All right. So going into this is where I think it's interesting. The yearly is really interesting. The one that I think is really interesting here is if we turn on our moving averages, look at right where we ended up. We ended the year just about right underneath the 18 MA. Okay, I'm going to take that down. Okay, on a weekly basis, our momentum is more or less it's getting ready to flatten out. We're stuck here on the 18 MA for the weekly time frame. Again, a lot of this kind of I don't know what it means or that it necessarily means anything. The other thing that I think is really interesting is it is a Doge, but hold on, I got to look at. Yeah, let's zoom this in so I can see it a little better. And I'm going to put a line right up here. So you're looking at a range that is really interesting, because you're going from about this 384 to 374. So you're really sitting in there where you're 2-3% trading range for the entire week, the last week of trading. Okay. It seems very strange to me that you would have, well, it doesn't seem strange. In the last week, I would expect not a lot of activity, not a lot of people making decisions, especially not a lot of buyers into that last day. I would expect that basically everybody, the bigger funds are harvesting their tax losses and stuff of that nature. Now, some stuff to know about that is those tax loss harvester guys, they're done. Okay. They can't harvest any more tax losses for the year. The other thing that is very interesting to know about that, they cannot buy back into the same products or into the same securities for at least 30 days. So you've got a really weird time where in the next 30 days, there's a lot of guys who sold out, who took losses, and they cannot come back in until closer to February. So again, part of the reason we think about this is because really where you want to see happen is the variability in range. So we go into this year, it is possible to think of this or see this as like a year, or this, especially this first week, again, another very tight range. And the reason I want to think about that is because I want to expect that there's a point where I shouldn't be trading, right? There's trades I shouldn't be trying to take, okay? So that's the only reason we think about this. Now, if we go in on the daily, we're in on the daily time frame, and we're going to put our Bollinger Bands on because this is going to give us some context. Okay, so you're in this weird sort of wafting spot right here. You're just sort of bouncing in this range. And again, this is something I talked about where I said you're just going to float underneath the 100-day moving average. And I don't have the 100-day moving average, but it does basically just run right through here. Oh, that is it. I do have it. Right. You haven't been able to, you haven't even made you made some little attempt here to get back to it, but you haven't really, you've got some green stuff hoping to get back to it, but you're held underneath it. The other thing that is very interesting, and I think for the month that you should be aware of, is that this 18-day moving average is coming underneath the 100-day moving average. So it's giving you, and this, just so you know, this 100-day average is below the 200, which is up here somewhere. Well, it's up here. This is up here was the 200-day moving average. You get your 100-day moving average, and now you got your 18. So your 18 is going under both of them. So starting out the year, you've got the averages stacked to the downside. This is a classic bear setup, okay? Again, right? So you're still continuing with the bear market at this point, okay? So I do say that your probably best trades are going to come in the short side into the bear market. That, but that, again, that's not rocket science. Okay. What we do want to do here is we want to start to tighten up, though. I've been much so about the context of the upward stuff and things of that nature. There are some stuff that I do want to point out. Okay. So again, this is where I really like this strategy here for the, if you notice, you come out, you start losing the oversold reading, and this is on the 4-hour chart. And from here, you make the move back up into the 18-day moving average or 18-period moving average on the 4-hour. And this sets up a pretty awesome trade setup because you very easily could have gotten from here to here a very profitable trade that you could have taken from here right back into the 18-day moving average. That is a very viable setup, but I think it needs to be shortened because I am a day trader. I'm trying to be a day trader. And you can see here, again, you came out of it, you blasted right up through the 18 MA. You're up here, right? Again, something that we could probably expect to happen going into the day is to come back and retest this on a 30-minute or shorter time frame. There's some other things that are also cool that you can see where I'm going to zoom this in because I really want you to see this. Okay, so some other stuff that's really interesting. So if you go back to the 18 MA, and once you start to see this, you can't unsee it. The slow stochastic came out of overbought, ran right to the 18 and rejected. This is just on the 5-minute alone, okay? Came back, it rejected, and it tested again, okay? Check this out. So we create a higher low on the slow stochastic. Okay, this time it still tries to reject, but on the next 5-minute candle, it blows all the way through. Okay. And once it's over this 18 MA, boom, it makes this huge explosive move all the way up. Okay. What I want as a trader is to figure out, and this I want to figure out how to avoid this trade right here and how to capture this trade right here. That is, and the reason I want this is because I don't want exposure to this. Okay. If I'm looking to be long, because we're coming out of oversold, right? How do I get this on the pullback and then capture that huge ride up to the top? That I haven't figured out yet. And this is what, like, again, my data collection is going for. Yeah, so this is really what I'm thinking about is this, right? You caught this big move up. So anyway, going into tomorrow, I'm definitely going to be probably, I'm probably going to be with the slow stochastic all the way up here. My next move is to catch a break to the downside. That would be my ultimate next goal, is to be looking for that, because you're overbought. So yeah, your trend is up, but you're overbought. So what I need from this is a break of momentum and to catch a trade to the downside. That's what I need. So that's what I'm looking for my next trade setup. If I'm following this just kind of along with the chart, that needs to be identified with proper risk reward. So I don't really know what that is yet. And I don't know that because I don't have the data. So again, look forward to tomorrow's show. I will have some data for you. It'll be very early on, so it will be a very tiny picture of anything. Anyway, as far as that goes. Coming into the week, by the way, let's go over this really fast. I didn't mean for this episode to be this long. Okay, let's go to Market Watch. Okay. Going to Market Watch. There we go. So coming into this week, non-farm payrolls. That's going to be huge. We're going to get the December non-farm payrolls. You guys want to sponsor Market Watch? You guys want to support them? That is coming on Friday. Jobless claims. So we're going to get a whole host of unemployment reports. So that should create a really good trading week, to be honest with you. That should create some volatility. Some guys play some bets based on that. I think that'll be good. So really, some of the stuff I will probably sit out the jobless claims report until after we have that. I'll probably not try and trade based on that. I don't think that is a gambler's game. I don't think that's a good setup. So we do have a lot of good information coming out about December. It's a good week. And so we get some manufacturing, job openings, job quits, whole bunch of data. So we'll see how it goes. All right, that is going to do it for me and the Russell Journal today. I hope you guys enjoyed the show. Let's go back in here. Thanks for checking out the show. Again, happy to have any conversation with you guys we possibly can. This whole show is about getting the conversation going on around markets. So that is from me to you, and around trading, becoming a better trader. So anyway, the Russell Journal, written, edited, hosted by me, Russel Liss. We're produced by Social Media Shows. Our executive producer is Maria Pureza. Please, by any means, if you're interested in doing a show like this, hit up Social Media Shows. They can help you out. And until next week, or until tomorrow, just pretend I said some sort of catchphrase.